How do you use life insurance in your estate plan in Canada? Well, do you know what happens to your wealth when you die? Do you know how much of your estate can be lost to taxes, probate fees, or delayed by a legal process? In today's video, we're going to go over how to use life insurance as a strategic estate planning tool to protect your legacy, to provide for your loved ones, and to ensure that your wealth transfers smoothly without half of it going to Ottawa for them to blow on whatever they want. Hi. My name is Laurent Munier, and I'm a partner and advisor here at Safe Pacific Financial in Vancouver, and we work with Canadian business owners and high net worth families all over the country to grow, protect, and transfer their wealth. We've been doing this for more than a decade. So in the estate world, one of the most overlooked but most powerful tools in the financial toolkit is life insurance. Sounds boring, but it's actually super interesting to people like me. Today, we're going to cover what estate planning really is and what it's not. We're going to talk about how life insurance fits into your estate strategy. We're going to give you a couple common mistakes to avoid, and also talk about why right now is the right time to get your plan in place. So, what is estate planning? Why does it matter? It's more than just writing your will. It's really about creating a roadmap for protecting your family, preserving your wealth, reducing tax burdens, ensuring that your wishes are followed, right? A proper estate plan can help you really avoid unnecessary taxes, unnecessary probate fees, delays, and even family conflict, which is a big one. And then why is life insurance such a powerful piece of this estate planning? Why is it such a good tool? So these days, especially, life insurance is really important in how your modern estate plan is put together. So number one, life insurance is a tax-free payout to your heirs. Life insurance in Canada pays out tax-free lump sum to your beneficiaries when you pass away. And it's usually pretty quick. And it can help people cover things like final expenses. It really helps to pay capital gains on anything that's grown over your life. Help to pay off debts, can help to take care of your young kids. Or it can help to, your family to preserve their lifestyle so they can continue to live in the house that they live in. They can continue to stay in that neighborhood. Your kids don't have to move schools or change soccer teams or whatever because they can afford to be there. Secondly, life insurance provides immediate liquidity. So when you die, your estate might be rich in assets, but poor in cash. Life insurance provides instant liquidity so that your heirs don't have to sell family property or sell investments or sell businesses to cover taxes or estate costs. Most life insurance companies in Canada will pay out a death claim check within 2 weeks of receiving the death certificate. We've actually personally hand-delivered multiple of these checks, and the insurance companies tell you 2 weeks, but usually it's somewhere between 7 to 10 days. But they say 2 weeks because they can usually do that. Now compare that with probate, which depending on the province you live in can take anywhere from 18 months to, we just had one where it took 10 years for probate to settle because the family was arguing over who got what and it was tied up in court. Yeah, don't do that, man. It took 10 years for this thing to settle and it didn't have to. It was just a mess. Number three, minimize probate and estate tax. So life insurance proceeds can completely skip the probate system when you've properly named your beneficiary. And then it also can avoid all those fees, right? So some of the stuff will go through probate, but the life insurance, if you set it up correctly, shouldn't. Another good reason is you want to equalize your estate. So if you've got multiple kids, or you've got kids from a previous marriage, or some of the kids are receiving certain assets and other kids are not, life insurance can help to equalize the estate. So for example, you have a family business and one of the children works in there and you're leaving it to that child, but the other child doesn't want anything to do with it and doesn't really care. Life insurance can provide equal compensation to the other kids, which avoids that unequal distribution of the estate. And really what it avoids is creating that resentment or that infighting or family disputes. And we'll talk about also if you own the life insurance in your corporation. So corporate owned life insurance, what does it do and how does it work? So a corporate owned insurance policy is usually a permanent policy that's purchased and owned by your corporation or your holding company. So it's usually you're the key person in the company and you're the insured. So if something happens to you, it pays out. And the corporation is usually the beneficiary. Well, the corporation is the beneficiary if you set it up correctly. And here's why this is a good structure. So the premiums are paid with your corporate dollars. So because the corporation owns the policy, those premiums are paid with corporate after-tax dollars, which are typically taxed lower than personal income. So this makes it significantly more cost-effective than a personally owned insurance policy. And then the cash value inside these policies grows tax-free inside that corporation, inside the policy, inside the corporation. So over time, a whole life or a universal life policy can accumulate tax-deferred cash value, which becomes a valuable corporate asset. And then the cash value can be accessed through, policy loans or collateral assignment to a bank. You can withdraw. And then you want to do that. The reason you're doing that is to keep the liquidity, right? So you can invest in your business or other investment opportunities without triggering immediate tax consequences. This is a big one. You get the tax-free benefit through the capital dividend account, or CDA. So on death, life insurance death benefit is paid to the corporation tax-free. And then whatever portion of that that's above the policy's adjusted cost base is credited to your CDA, or capital dividend account. So this allows the corporation to pay out a tax-free capital dividend to your Canadian resident shareholders, is the official thing, but that's basically to your heirs, right? To whoever you have as the people that you want to receive that. So this creates a seamless and tax-free wealth transfer that bypasses the 40% tax hit that would normally happen if you were passing the money from the corporation to your kids without the CDA. And some of the top benefits of having your life insurance owned by your corporation. So number one is to cover estate liabilities. So if your estate includes high value assets like real estate or private company shares or investment properties, your heirs or your beneficiaries may face significant capital gains taxes when you die. So life insurance provides immediate tax-free liquidity to pay those tax bills without having to sell assets or without having to borrow money. It's a good way to extract retained earnings from the company in a very tax-efficient way. So many business owners will have significant retained earnings inside the corporation that they've built up over their life. And probably it's inside a holding company versus your operating company. So when you pass that on to your kids or to your family or whoever you want, your beneficiaries, when your beneficiaries want to take that money out, this would usually result in a high personal tax that they would have to pay. With the corporate-owned life insurance policy, most or all of those retained earnings could be passed tax-free to the beneficiaries through the capital dividend account when you pass away. So this is a huge tax advantage. You also would want to use your corporate-owned policy to fund a buy and sell agreement to pay for key person insurance. So life insurance is often used to fund a shareholder buyout agreement or a buy-sell agreement, which can ensure that your business operates smoothly if one of the partners passes away. It also protects the business by covering the financial impact of losing that key person. So you're gone, you're probably very important to the company, so they need to replace you somehow, or they need the money that you were bringing in to keep the lights on and to pay the rent or pay the mortgage, right? So it's important to have that insurance there for the buy-sell agreement. Also from your family and legacy protection. So if you have a blended family, say you've got children from multiple relationships, or you want to leave a charitable legacy, life insurance gives you that control and that flexibility. You can allocate the death benefit as you want so that you can equalize your estate, or so you can fund charitable donations in a tax smart way. So a real life scenario where the corporate insurance made a big difference. So let's say you own a cottage or a rental property or some other high value asset that has a large unrealized capital gain. The life insurance can cover, your estimated capital gain that tax is going to trigger when you die. So this allows that property to stay in the family instead of having to sell it so that you can pay the CRA their tax. Another thing is if, say you're incorporated and you've got $1 million in retained earnings. So your corporate owned insurance lets you move that wealth out of the holdco and then into the hands of your beneficiaries through the CDA, again, without that big dividend tax burden. Here's another big one. This comes up all the time. People that get remarried or have blended families. So you kids from this marriage, but now married into this marriage, maybe kids from that marriage. It can kind of leave an estate planning mess if you don't do it properly. But designing a policy that has clear beneficiary designations can prevent estate conflicts. And it can ensure that all the family members are provided for appropriately, even if not everybody likes each other or not everyone agrees on how the estate should be divided. Maybe you want to donate to a charity as part of your estate plan. So you could name a charity as the beneficiary, or you could use a tax credit from a charitable donation to offset final tax bills. So this leaves behind more money for your family. Also, you may just want to avoid delays, you want to avoid confusion, or you want to avoid family conflict. Insurance pays out pretty much immediately, pays out tax-free, pays out privately, and it avoids the long and public delays of going through probate or having a contested will and having to deal with things in court. Yeah, the life insurance payout definitely beats tying things up in court, in probate court. Some common estate planning mistakes that we see and how we can help you avoid them. So when it comes to estate planning, even small oversights can mean big problems. So we often meet successful Canadians. They've spent years building wealth. They've spent years building their business, working hard every day, but they didn't take the steps to protect it for the next generation. Estate planning is not just about drafting your will, right? It's about ensuring that your legacy is passed on efficiently, tax effectively, and exactly the way that you want. So here's some of the common estate planning mistakes that we see, and then how we can help you avoid them with clear and personalized strategies. Biggest one, no will, or an outdated will that doesn't reflect your current situation. So a crazy number of Canadians either don't have a will or haven't updated it in many years. So this can create serious complications and delays and unnecessary taxes and fees if you pass away and there's an estate settlement period. Like seriously, if this is you, you don't have a will, go get your will written and updated right now, right? Why does this matter? Without a valid will, you're considered to have died intestate, which means dying without a will. So your estate is subject to provincial laws, meaning the government is going to decide how your assets are divided. And there's a certain way that the provincial government will do it that may or may not match with how you want your assets to be divided. Yeah, regardless of whether you want it to go like that or not, if you pass away without a will, without having your wishes specifically clearly laid out, it's going to go through the intestacy process. Also, an outdated will can cause unintended consequences, right? Especially if you had major life changes, like you got divorced or remarried, or you have new kids, or you sold a business. So we can ensure that your insurance and that your financial planning aligns with the will. We don't set up your will. We're not lawyers, but we can work with your legal team, or we can introduce you to lawyers in our network to make sure that everything is current, it's coordinated, and that we're avoiding probate delays and potential disputes in the future by making sure that what the will says and what the finances say line up. Another big one too is not naming beneficiaries on insurance or investments. So this is one of the simplest and most effective estate planning tools, is just naming beneficiaries on all of your accounts, on your insurance policies, your RRSPs, your TFSAs, any investment accounts. If there's an opportunity to name a beneficiary, you should put somebody's name in that box, because if that just makes that process so much easier. We often see clients who leave these beneficiary boxes blank, or they have somebody's incorrect name. Maybe, yeah, they just have the wrong name, especially if culturally you have a certain name, but then in Canadian, you have a different name. You should use your legal, or not yours, but their legal names. And then why does this matter? Without a named beneficiary, your assets could be paid into your estate, which makes it subject to probate and makes it subject to fees and makes it subject to taxation. Even worse, your wishes may not be followed if the beneficiaries are incorrect or if the beneficiaries are outdated. We've actually had this case in the office where somebody had been broken up with somebody for quite a long time, but this person was still named as the beneficiary on an old insurance policy. So if this person had passed away, everything would go to this guy that she really didn't like anymore and would skip her current family and the new person that she was actually married to. And this was, yeah, as soon as we saw that and explained it to her, she freaked out. She was like, change that right now. So yeah, if you've got outdated beneficiaries on old accounts, please update them. It's very, very simple to update. We want to make sure designations are correct. We want to make sure they're current, especially when it comes to your life insurance or joint accounts, investment accounts, registered investments, all of these types of things, make sure your beneficiaries are named. Then we talk about owning your life insurance. You can own it personally or you can own it corporately. So let's talk about the advantages or disadvantages of each. There's big advantages to owning your life insurance inside the corporation. So like we said, right, you're paying with cheaper corporate dollars and then you get that capital dividend account creation on death. But you probably also have personal insurance needs. So something most of our clients have is a mortgage on their primary residence. A lot of them have young kids. So having some insurance held personally gives you that protection for your personal life. So as a successful business owner, you probably have both corporate and personal insurance need. We work with this a lot and we can advise on the right types and the right amounts of insurance to own personally and the right types and amounts to own corporately. We'll also work with you over the years to make sure that the insurance plan that we set up for you today still makes sense and is up to date in the future. Another big mistake, no strategy for covering the tax bill on death. This is a big one. Many Canadians really don't understand the tax impact of dying. Capital gains is huge. Capital gains on rental properties, on a cottage, on corporate shares, on your RRSPs, on non-registered investments. They can be huge tax bills for your estate and huge tax bills for your loved ones to pay. Like, how are they going to pay these taxes? Do they have the money? And then why does this matter, right? Without proper planning, your beneficiaries might be forced to sell assets, even family properties or shares in the family business to pay the CRA. We use tax-efficient life insurance to create a guaranteed source of liquidity on death so that your beneficiaries can pay the taxes without selling off key family assets. Another one too is leaving your RRSPs or your real estate exposed to probated taxes. So registered accounts, RSPs, TFSAs, real estate, common sources of estate friction. If these things are not properly structured, they can create large tax liabilities. They can get tied up in court. They can result in uneven inheritance between the beneficiaries. Why does this matter? Well, RRSPs become fully taxable as income when they're passed to your beneficiaries, except when you do a spousal rollover. You can pass it to your husband or your wife, but if you're passing it to kids or anybody else, all of that is fully taxable. Real estate that's not your principal residence also will get hit with capital gains and probate delays. Even your primary residence can pass to a spouse and keep the primary residence exemption, but it can't pass to your kids or to your grandkids or to whoever else you want. So that, again, huge source of capital gains tax. So what do? We review how your assets are titled, right? Who owns it? Who's on title? Where do the beneficiary designations apply? And then we use insurance and trust strategies to minimize tax exposure and to protect family property, especially family property that's important to you that you want to keep in the family as a legacy. Another big problem, failing to communicate your estate plan to your heirs. You might have a brilliant estate plan, but if your family doesn't understand your intentions, it could still lead to confusion, it could still lead to conflict, it could still lead to legal battles. You don't just write your will and throw it in a drawer and never talk about it to anybody. Estate plans work best when everybody's informed and everybody's on the same page. Again, why does this matter? Lack of communication can lead to family tension. It can lead to disputes over fairness. It can lead to mishandling of assets, especially in blended families where one child is, or children from this family versus this family or this marriage versus this marriage. Yeah, it can become quickly a mess. So again, we help you to create a plan that's not only strategic and tax efficient, but also clear and explainable. We can also help to support your family conversation. We can work with your lawyer or with your accountant to ensure that your values and wishes are well understood and transferred to the next generation. So some final thoughts. Build yourself a legacy, not just an estate. So estate planning isn't just about dividing up your assets. It's about creating a clear, intentional path for your life's work to continue benefiting the people and the causes that you care about the most. So whether you're a business owner that has retained earnings inside the corporation, you're a real estate investor, you've got significant capital gains, or simply you're somebody who wants to leave your family in the best position possible, you need to plan ahead. So at Safe Pacific, this is what we do. We specialize in helping Canadian families and business owners use tools like life insurance, corporate planning, beneficiary planning to create efficient, tax-smart estate plans. We help you to avoid common mistakes that cost families time, money, and peace of mind, and we work with your legal and accounting team to ensure that your legacy is preserved the way that you envisioned it. Estate planning with life insurance is one of the most effective ways to protect your wealth, to reduce taxes, and to provide immediate monetary support for your heirs when they need it the most. When it's done right, it ensures your estate's not only preserved, but it's multiplied, and it's organized, and it's transferred with a purpose. If you want to start your estate planning journey or to review what you already have in place, let's connect. The best way to do that is through our website. It's safepacific.com. Send us a message there, and somebody on the team will get back to you within 24 hours on business days to set up a meeting time and to get to understand your situation and your goals moving forward. I hope this was really beneficial for you and that you learned some stuff. Not a lot of people know how the estate planning process works, but if you did like this video, if you did get something for it, please, can you do me a favor and click the like button? If you have any questions, you leave them in the comments below. If you're not subscribed yet, what are you waiting for? Hit subscribe. It really helps to pump the algorithm, and it helps to get this video out to more successful Canadians who want to take care of their families just like you. That's it for me today. I will see you next time.